Very pleased to be asked to moderate this panel, which is essentially about what do asset owners expect from this market. The past 2 days we've heard quite a lot. We've heard a lot about demand for securities finance from hedge funds and banks. We've heard how the market is dealing with some of the challenges, particularly the regulatory ones. We've heard a bit about market conditions, the low and negative interest rates that we see in the short-term markets. We've heard about collateral dynamics and market infrastructure. So we've covered a lot of ground, but of course large parts of the securities finance markets only work if asset owners are willing to participate, particularly securities lending. If asset owners don't make their securities available to lend, then a lot of what we do is redundant. So it seems to me that it's pretty important that we understand what the strategic issues are for asset owners, what they care about. So as well as us worrying about how to optimize the market that we operate in, we need to keep a little eye on what they're worrying about, which might be different to what we care about. And now asset owners come in many, many shapes and sizes, and I think our panel today represents a good mix of some of those asset owners. And two of our panel may need little introduction to many of you because they've been involved in the securities finance industry for some time, but two others of our panels come from outside of our industry, and I think that we're going to get an interesting perspective, and I suspect that they don't spend very much of their time, in common with many asset owners, thinking about securities finance. So I'll just introduce our panel. So starting on my left, we have Andrew Jameson, who's an MD and head of EMEA Client Execution and Broker-Dealer Sales at iShares, a large ETF provider. Then next to Andrew is Nicholas Fursley, the co-founder and director general of the World Pension Council, a Paris-based organization that works with the largest pension funds and sovereign wealth funds around the world. Next to Nicholas, we have Rudolf Siebel, who is a managing director at the BVI, that's the German Asset Management Association, who represent German asset managers and investment funds. And finally, Roy Zimmerhansel, who is the global head of securities lending at HSBC Securities Services. And I think each of them will have a different perspective, and I think Roy can comment generally as we go through this discussion on what he sees the issues for his broad set of clients being. So we've got about 5 questions that we're going to run through today, and just to give you a sense of what we aim to cover, we're going to ask the panel what they consider the strategic issues for asset owners to be. What are asset owners, investors caring about? And then we're going to ask them a little bit about what they think about the securities finance markets and how do they perceive securities finance. We're going to ask them a little bit about the role of securities finance as a collateral management tool, which has come up a little bit earlier today. And we're going to ask them a bit about the relevance of securities lending returns in the context of what's going on in the marketplace. And finally, if we get time, we'll ask them for what their advice would be to us as an industry if we want to continue to serve those asset owners' requirements. So let's kick off with that first question. What are the strategic issues that asset owners care about today, and what's on the sort of priority list? And Nicholas, perhaps you could kick us off with that one.
Right. I'd say beyond regulation and fiscal and legal consideration, I think there's a kind of a secular trend that started 10, 12 years ago, but it has really accelerated in the past 4 or 5 years, which is for large pension funds, retirement schemes, but also sovereign wealth funds and national social security funds to slightly reduce the proportion of equities and bonds they have in their portfolio. And within that core allocation to equities and bonds, progressively shift away from actively managed mandates to various forms of passive low-cost management. So that trend is really accelerating, and as a consequence of that trend, they tend to be increasing their allocation to alternative and real assets. So obviously that is hedge funds, private equity, real estate, but also more recently infrastructure. And all that is happening at the same time, and I think it's fairly interesting, notably for you guys, because if we go back 6-7 years ago, at the end of 2007, there were many pension fund executives and policymakers in South Korea, Japan, Germany, France, who were really opposed to hedge funds or even shorting stocks or lending stocks. He was very polemical 6-7 years ago. And if we look at what has happened since then, on average, large pension funds, including public pension funds, where you have 50 or 60% of the trustees who are nominated by progressive or left-leaning labor organizations, so including these public civil servants pension funds, what they have done in the past 6 years, they have nearly doubled their allocation to hedge funds, private equity, and other alternative assets. So I think it's interesting. They have voted with their money, in essence, and all these negative, I think, headlines we saw 6-7 years ago against securities lending and hedge funds have to a large extent vanished, I think.
Okay. Rudolf, you represent a very large community of asset managers in Germany and investment funds. What do you see? What are the priority issues for your members?
Well, my members, who are 80 asset managers, mainly UCITS and AIFM in the German marketplace, covering about 2,000 billion euros in assets under management, are mainly obviously invested in long-only funds. So we are looking exactly at the trends you are mentioning. So there's increased pressure on them, on their profitability, and also on the returns they have to deliver to their clients to maintain clients, especially institutional clients, in the funds. Ultimately, obviously, these funds either directly or indirectly serve, for the most part, pension savings. And how to increase returns in a low interest rate environment while at the same time you are limited to the traditional asset classes, for the most part, is, I guess, from a management point of view, their most concern. My concern as the managing director of the association is obviously keeping the costs down, which comes in from the regulatory side. And without taking too much of your time, I just want to throw in a few things. We are just finishing with the registration of the funds and the management companies for AIFM, which has been a huge work. We are looking at MiFID II coming in. 844 pages have been published by the European Securities Watchdog ESMA to be consulted till the 1st of August, which will considerably change trading venues, especially the use of dark pools by my members. We are looking at EMIR and linking up to CCPs. And we are also looking specifically in the area where you are interested in, towards, for example, the EU regulation of January, which came out in draft form on securities financing, where from my members' point of view, we get a lot of double reporting requirements on top of what we already have in terms of securities lending and repos, and that won't make the interest in your product much easier. Just to leave it at that.
Yeah, thank you for that, Rudolf. Before we open up a bit wide, what I've heard actually from Nicholas and Rudolf there, regulation is a key issue for asset owners. That's not a surprise. But this trend towards diversifying their investment base and looking at alternative forms of investing, what's driving that, Nicholas? What's making them want to do that?
Probably first that the returns on these core assets are not what they used to be. I think we have a chart that we if I can, if you have the...
Should come up.
Okay, not sure we have it, but anyway, so okay, it's here. So this is really the 25 years before the crisis, and things were easy. So on average, if you were a U.S. or German or French pension fund, you would easily earn 11-20% per annum for equities, 7-8% per annum on average for bonds. So a very basic, simple allocation, 60% bonds, 40% equities would yield easily 9% per annum without any big effort. You can subtract 1% or 1.5% for management fees, but at the end of the day, you would easily get 7.5% per annum on average of return. Now, this is the actuarial assumption that is still used today by the vast majority of pension funds, be they public or private pension funds. But unfortunately, the annual return on these asset classes isn't as high if we look at the past 4 or 5 years. So if we move to the next slide, looking at the past 4 or 5 years, things are less rosy. So if we take the November 07 until sort of December 2012, 3.5 year period, On average, US equity would only yield 0.6 or 0.5 per annum, US bonds 5.8. So your typical portfolio for your average pension fund would only yield 3.6% per annum. Remove 1.5, 1.6 of management fees, you're left with only 2% per annum, right? And this is real life figures. Now, if we're a little bit more optimistic, if we stretch that period, if we start in November 27 and we keep counting until today, so June 18, 19, 2014, so it's like 6.5 years. If you look at this period of 6.5 years, counting the rebound in equity market that was exceptional last year, you have an annualized return for equity of 4.5, 5%. Bonds would give you 4.5, so your typical average pension fund portfolio would yield 4.5% per annum. Subtract the management fees, this is only 3% per annum on average. And the problem is that in most cases, the actuarial assumption used by governments and corporations is still the one from the previous 3 or 4 decades. So they're still assuming that they will earn 8 or 9% in perpetuity, when in reality, they have only earned 2 or 2.5% per annum in the past 6 years. So there is a mismatch. And obviously, one of the ways to mitigate that mismatch is to bring in more alternative asset classes. One more reason that is pushing people towards alternatives, and we don't see it here, we have to imagine the future, is that quantitative easing for the past 4 or 5 years, QE1, QE2, QE3, etc., really interest rates are very low now. So obviously, these returns on bonds are completely out of the question for the next 5 or 10 years. So we know for certain, even if we assume that inflation will remain low, that the fixed income part of the portfolio, because of quantitative easing, will be quite mediocre at best. So people have to engage in what they call the quest for higher yield. And I think this move towards hedge funds and private equity is part of that quest for higher yields.
And in our discussion beforehand, the other big problem that we noted, I think, was that we're all living longer. I think that's a problem, isn't it?
Yeah, longevity risk. Longevity risk is a big elephant in the room, and in most cases, it's unaccounted in terms of in the metrics used by governments or pension funds. What they call longevity risk is at best, in some instances, partly accounted for, but in many cases, it's totally ignored. And I'll let Andrew, I think he has a nice, interesting table on that.
Sure. Yeah, no, I think clearly longevity is a major and probably even the single biggest issue that the investment management community is faced with. It's funny, just kind of stepping back just for one moment as a backdrop, having spent the vast majority of my career as a practitioner rather than a beneficial owner, I would echo one of the phrases from the previous panel about thinking that securities lending is the bedrock of everything that we think of. And one of the kind of points I wanted to bring out is that it's very much a peripheral activity when you're an investment manager. It's very important, so please don't get confused by thinking that securities lending is not important, but it's certainly not the sort of key high priority issues that we like to focus on. And clearly for us, investment performance is the most important thing, product offering, product innovation, client conversion. And why that's important is because we have this longevity issue, because people are living longer. So I put together what you will agree is a very crude slide this morning, and just to try and really kind of illustrate those points. I mean, if you look at the major demographics from the most populous developed markets, in our lifetime, arguably, or within a generation, over the last 50 years, life expectancy has increased significantly from just under 70 years to currently over 80 years in many instances. So that's between a 15 to 20% increase in the last 50 years. And that's going to have major implications in terms of the continued reliance on investments for future generations. What is really stark is the column on the end, the dependency ratio, and that's a measure of those that are yet to come into the employment arena and those that have exited. To think about people who've yet to reach 16 and people that are 65 and over. And that measure of the people that are retired or not yet working and are relying on the working population is getting quite frightening. And if you look at Japan, which is probably the most extreme example, that's reaching 40%. So, you know, the classic urban myth is that in Japan, they sell more incontinence diapers than they sell baby diapers. And clearly that's going to have a major problem going forward. Just in simple terms, the world is getting a lot older. In 1950, 8% were over 60. In 2000, it was 10%. And by 2050, it's due to be 21%. So this is a major, major problem going forward in terms of having investments that will continue to yield a return to pay for all these retirees. And I think that while it's a very daunting concern for our industry overall, it does have a very positive impact for securities lending, because what it ultimately means is every last investment return counts. And you know, I put in that little quote from Albert Einstein, who said that it was the 8th wonder of the world, compound interest. And we can look to see why that actually is important in relative to securities lending. I put together this a little bit more technical graph. Okay, so someone else put it together for me. And it just really takes some of the numbers that Nick talked about earlier. If you look at the very large columns on the left-hand side, that's using that 11% kind of gross number of equity performance over the investment period from, you know, back in the mid-90s when we went through that great bull run era. And you can see the difference on the left-hand side, stripping out securities lending return, using a modest 20 basis points figure, versus on the right hand, the lighter green of what it would throw in. So in bull market instances, it's probably less important. But if you look post-crisis, and you look now to a market where equity return from a pension perspective might be around 2% after fees, it has a very stark impact in terms of not only the gross return, because you can see the columns are a lot lower. And we've extrapolated this out for the same time frame. So it's not just a case of this is only a shorter duration. That would be over the same sort of time frame, as it were. And you can see that it has a major, major impact. But positively for this market then, the actual percentage improvement through securities lending of 20 basis points year in, year out has a stark improvement. And that's a very positive message. And I think from yesterday's cash debate panel, the room was really 50-50 split, in so much as half the participants here felt that it needed to be a 25 basis point plus increase in returns to have a meaningful impact for that additional risk. Well, these numbers here suggest that 20 basis points alone, as you look at the graph on the right-hand side, how the performance continues to increase and grow and widen, has a big impact.
Thanks, Andrew. And we're sort of now merging into the second part of the discussion, which is about the role of securities finance and the perceptions of securities finance. And perhaps we could just have our first e-voting question at this point, and then I'll bring Roy in to get some comments on this. And this is a really, really simple question, and I deliberately didn't put "don't know" up there because I just want to get your perception on this. You know, do asset owners generally care about the returns that are available from securities lending? Do they consider them to be worthwhile? If you're not an asset owner, I'm just interested in your perception of whether you think they do or they don't. Okay, well that's pretty encouraging, isn't it? I think it's two-thirds think they do care, a third think that they don't. So I'm broadly encouraged by that. I think that's a good start. Roy, you speak to a lot of different clients. You have a range of different clients. What are their views on well, first of all, what do you think their strategic issues are? And then what do you think they think about securities finance?
Okay, thanks, Kevin. So I think building on some of the things that we've actually heard from the group here, you know, the reality is, I think as Andrew said, you know, this is not a mandatory requirement. So while it's nice that two-thirds of the audience here thinks that the view is that asset managers appreciate the value of securities lending revenues, the truth is 10% of institutional money lends. So 90% of the institutional community obviously doesn't think it's worth it or worth enough to do it, or they have restrictions. Right? So the universe is already a pretty small universe, right? But then if you go to sort of the practical impact of some of the things that we were talking about here, so we look at the returns after costs. So how do you reduce costs as one of your key issues? So what does that mean? It means you have more indexation, and we see that across all of our clients. We see more indexation into, you know, pooled funds or ETFs or other vehicles that way, and that presents its own issues. So if you're competitive and you're using the same pooled vehicle as someone else, how do you actually get a better performance? Well, you can't unless you find another way to get returns from that. If your sovereign bond portfolio, which used to give you sort of 4, 5, 6, 7% yields, is now yielding 200 basis points, well, you got to do something with that, because you do have those targets Nicholas was talking about. So again, we see rotation from sovereign debt into corporate debt to get a higher yield there, and then that throws out implications as well. So what do we see? We see more corporate bonds in our lending portfolio, which we have to find a better way to distribute, because goodness knows there's so many corporate bonds out there, and people are only looking to borrow a handful of them. So how do you deal with those sort of conundrums and deal with that? So the returns for that community, which maybe wouldn't have looked at it at 500 basis points, all of a sudden 20 basis points from a collateral transformation trade on a bond that's generating 200 is actually a pretty significant uplift on that asset. So you're going to have a residual sovereign bond portfolio. How do you get value out of that? You're going to have corporate bonds, but again, it's such a wide mix. How are you going to get value from those assets? So that's where I think, while the point is maybe that this isn't the bedrock of the industry, it's becoming a much more critical tool, whether it's on the equity side or the fixed income side. And then I think, oddly enough, the crisis is the thing that will ensure the longevity of this business. So we all experienced the impact of the short selling bans in sort of 2008, and for some countries a few times after that. But the reality is the outcome of that actually is quite positive, because regulators have looked at short selling and securities lending in depth for the first time, really, and have come out and said, hey, actually, if it's properly managed, prudently conducted, and there's decent oversight over this, it's actually beneficial to the marketplace. So all those asset managers, that 90% that don't still today lend out their assets, some of those are lending today that didn't lend before the crisis, because they're hunting for yield, and the regulators are saying it's okay. So now we're in a situation where in some cases we're oversupplied, right? And you know, and that's something that usually comes up, is new supply cannibalizing old supply? And so we really any better off? And I think that's where the real challenge is, and that's where the interaction is with the asset owners, is how do you extract value from those portfolios? And the answer there is, frankly, if you think you're just going to give them to your custodian, who's just going to lend them out and take the same collateral under the same terms on all the transactions, and you're going to make more money, it's just not happening. So the challenge for them and for the industry is that, how do you do unusual things? How do you do non-standard things? Do you do evergreen or fixed term trades? What can you do more to extract value out of corporate action activity, right? Are there different ways to structure your portfolios? We talked about some of the synthetics and so the trading opportunities there. So that's the challenge. And I think as providers to those beneficial owners, our challenge is to A, remember this is optional, make it too hard and they won't do it, right? And B, present that range of options to clients. So I think, again, it was mentioned on the last panel, just because there's an opportunity to make more money doesn't mean anyone's going to do it, right? We have to make it easy to do. We have to make it sensible. It has to be more engaging. It has to generate a better return, right? But it has to be doable. And that's where you get the range of choices by the client, saying, yes, we will do this to get that return. No, we won't. It's okay to continue to do securities lending the way that you did it 10 years ago. Just don't expect to make as much money.
So, Roy, I'm going to stop you there, because we'll come back later to ask particularly Nicholas and Rudolf for what advice they would give to us, as opposed to the advice we would give to asset owners. But in the last discussion we've just had, we've heard a little bit about investment performance and this realistic sort of view of the world now, which we're living in a time when investment returns are going to be lower than they have been historically. We're living longer. I think that's a good and a bad thing. We're going to live longer, but we're not going to be able to afford to live longer by the sounds of things. But we heard a bit about investment management fees, and there's a tremendous focus on the costs, not just investment management fees, but costs of investing, and how relatively small costs can make a large difference to the investment returns that are achievable over time. And can we have our second e-voting question? Because I know the UK authorities are particularly focused on the impact of relatively small costs. And so here's a question for you. And before you go reaching for your calculators, you don't have enough information here to work it out, so I just want you to guess at this one. When a management fee of 0.5% reduces the accumulated savings of a typical employee from £440,134.75 to okay, so that's 68% of you got it right, and so in real money terms, and okay, these numbers look rather big to me, but they are from the Office for Fair Trading, so I believe them to be true. But in real money terms, we're talking about 50 basis points of cost, taking away £50,000 from a typical employee or participant in a pension fund. Now, if you turn that around and you were to consider, well, you know, small increments to those portfolios over a long period of time can also make a difference, a real tangible difference to the returns. And I think we probably as an industry need to be able to articulate these kind of effects perhaps a little clearer than we have done in the past, but they can make a meaningful difference. I'll turn back to Nicholas now. And in your perspective on securities finance, does it ever come up in your discussions with the chairman and CEOs of the big funds? And if so, what are they thinking about, and what do you think they should care about in terms of securities finance?
It does, but it's clearly, I mean, I would agree with what Andrew said earlier. It is not, or it hasn't been historically a central issue. That was really peripheral, and once again, peripheral not in the pejorative sense, but it was really a secondary or tertiary issue. But in the current, low yields, low cost environment, I think things are really changing, and they're changing on many fronts. As we discussed earlier, one way of viewing things moving forward is that incremental 15, 20, 22 basis point per annum compounded, that can make a huge difference over 10, 15, 20 years. Another way of viewing things is that clearly the proportion of pension money going into hedge funds, absolute return, private equity, and many of these private equity funds themselves do LBOs, MBOs, and they resort to various forms of securities lending, right? So it's not only hedge funds, it is also private equity and other branches or other asset classes. So the need for securities lending, broadly defined, will increase a lot, and it has started to increase mechanically. I mean, if you look at the past 6 years, on average, large pension funds and large sovereign funds have more than doubled their average exposure in 7 years to hedge funds and private equity. If we look last year for the first time in history, pension funds have become the biggest client base for the hedge fund industry. It used to be private bankers, high net worth individuals, endowments, not anymore. Now it's pension funds, and in many instances, it's public pension funds. So I think clearly moving forward, I think the centrality of securities lending to the asset owners will change for the better.
So that's good news in a sense. So if we get our act together, it does seem like it's a good opportunity and good time to start talking about securities finance in a way that's meaningful to asset owners. Now I'm going to switch a little bit now, because although we've talked about collateral at the conference quite a bit so far, I am interested in our panelists' views on how they see the securities financing markets playing a role for them or their clients or their members in terms of collateral. Rudolf, does collateral management and securities finance come up in the world of German asset managers?
Yes, especially with the rise on the discussion on EMIR, has become very much to the forefront, as we are now required to post collateral both on bilateral transactions as well as on transactions going through the central clearing parties. there is constant demand for the collateral, especially required by the CCPs, which has given rise to collateral upgrade trades. So the typical example of an equity fund having to post government collateral or cash collateral would either mean if he goes too much into cash, that is a yield stopper. Government bond the fund doesn't have, so it would have regularly engaged into trades trying to convert part of its equity holdings to cover for their derivatives transactions by getting, for example, government collateral. So securities lending here certainly is very important, also because that would also yield the cash to be able to be posted as a collateral. One problem with that is, however, that under the existing diversification guidelines and reinvestment guidelines, it is not clear that the cash received out of a securities lending transaction to the fund can be used in long chains of reuse. We are working actively in the discussion of implementing of CCPs that at least that cash can be used, or the first level of collateral received can be used as collateral, for example, to be posted with CCPs. On the other hand, the CCPs obviously are having realized that there is a business out there and are broadening the range of acceptable collateral. So it may not as easy as I explained, because depending on haircuts, obviously CCPs might accept then the equity of the fund too. So overall, I think the major use is still, as you had explained, the search for additional yield. And here it's a balance between what kind of collateral you can offer to securities lending parties, how much you have. So we see in our membership that usually larger managers with large portfolios can do it. Large managers with small portfolios are not doing it, and small and medium-sized managers are not doing it. Also because the whole regulatory overlay for the regulated asset manager is quite strict. We have strict counterparty limits, for example, 10% on the counterparty. We have diversification on the collateral received guidelines. We have the already explained limits on reuse of the collateral received. And so from that perspective, the offering to the asset manager would need to take also into account to relieve the asset manager somewhat of these burdens.
Thanks, Rudolf. And I'm conscious I'd like to leave some time for Q&A here. Mark, how much time do we have?
You have 2 minutes.
2 minutes, okay. Let's stop there. And I'll just very quickly summarize what I think I've heard now. So in terms of asset owners and thinking about pension funds, sovereign wealth funds, institutional investors, securities finance is not one of their priority issues. They care about investment returns and how they're going to get investment returns. They care about the fact that they've got to manage the fact that people are living longer and need to hopefully have long and healthy retirements and pay for that. They care about regulation, but sometimes different regulations to the ones that we care about. But I think we've also heard how securities finance can be quite relevant to those asset owners, given all of those challenges that they have, and particularly the role it can play in either helping them with collateral requirements or providing some incremental return, which over the long run can actually play a significant role. So let's just have a quick open up for 1 or 2 questions if you have them. Come on, I've stopped early for this. Okay, I have a question in the front. Thank you.
Thank you. Roy, this is probably a question directed at you. You talked about the 90% that didn't take part in the securities lending. When you talk to them, what is the main reason they give you? Is it like a systems issue or credit issue or understanding of the product? What's the thing that's really stopping them from entering the market?
So that's the $1 million question, which I think everyone would like the answer to. I think it depends on the fund, right? So structurally, some are just cynical. They don't believe in the product, so the regulatory issue addresses that. Some have never been concerned about the returns. It's never been important enough. So the current environment changes that paradigm. Some of them have never been forced to do that. So that's why we see some people getting involved in collateral transformation trades that don't do lending because they're forced into it because of EMIR and other sort of related sort of regulations. So they're being forced into that as a priority. I saw a fund manager a couple of weeks ago. They said, yeah, well, so this year they're going to do repo, collateral transformation, and securities lending. They're going to do all of that this year for the first time. And it's actually sitting them down and saying, okay, so let's look at what's most important. You're this type of a company, so you actually need to do collateral transformation to allow you to continue to do derivatives. So let's concentrate on that first, right? So I think the answer is different for everyone. And, you know, that's part of the challenge, you know, and I also think that's also part of the opportunity, because you can now find aspects of the business that will be more of interest to individual firms or individual entities that have never had the need before, and now you can come to them with solutions. So many and varied.
And can I maybe just interject and put in maybe a slightly controversial point to add on to Roy's? You know, in my role, I kind of see both sides of the coin, because not only are we looking at lending as a large asset holder ourselves, but I'm engaging as a product provider with a myriad of different beneficial owners and investors who buy our product. And why we're here, myself and my colleagues, are really to try and promote the lending of ETFs, collateral acceptability, etc. So as part of the norm in our dialogue when we sell our product to buyers is, have you considered lending? Do you want to lend? Are you lending? And it's staggering the number of people that to date don't know that they can lend ETFs or are not lending any assets. So I think there's a real education issue that needs to be tackled and addressed as an industry to get out and meet with your clients. One of the things that I felt from this conference, because we kind of jotted some notes on one of the potential questions, was what advice can we give to the industry? And it's really about not being too inward focused. A lot of the debate that I've heard since I've been here is about balance sheet. It's about capital requirements. It's about banks talking about bank issues, and it's not looking through the customer's eyes around being a client business and what we can do to innovate and drive things forward. So I think that's the key message, is get out in front of people, tell them what securities lending is, because it's still a relatively light understanding of what is possible and what is not.
And just one sentence. Look at the whole arrangement. Look at the asset manager and look at the custodian he needs to use. Because if the custodian cannot support your product, for example, in collateral management, then the fund is not going to change the custodian, which is provided for in the prospectus, simply because you make him an offer. So look at the situation as it stands.
Now, on that note, I can see a man in the corner reaching for his red card, so we're about to get sent off. I'd like to thank our panel and thank you for attending this morning's session. Thank you.